Hello everyone, my name is Sajjad Al-mattar. Today I will talk about my topic, which is impact of operation cycle and balance sheet. Firstly, we want to know what is meant by an operation cycle. Operation cycle basically refer to the day required for a business to receive inventory, sell the inventory and collect cash from the sale of the inventory. This cycle play a major role in determining the efficiency of business. So basically, the operation cycle mean the time required to collecting cash from the inventory, from selling the inventory. This is basically a figure about the operation cycle. So firstly, purchasing good or material, then reduce good or service for sale, then sell good or service, then collecting cash from customer. So the period basically beginning from purchasing good or material and ending in collecting cash from customer. So now we have example of the operation cycle. A food store purchase an inventory and then sell the inventory for cash. The short time that the inventory remain in asset of food store represent a very short operation cycle. So the time from purchasing inventory for the food store to the sale of the inventory for cash, this is the operation cycle time. The operation cycle have a formula as follow, which equal inventory period plus account receivable period. The inventory period is the amount of time inventory set in storage unit sold, whereas the account receivable period is the time it takes to collect cash from the sale of the inventory. This is some concept we needed in the operation cycle formula. Inventory period equal 36.5 divided by inventory turnover, where turnover equal cost of goods sold divided by average inventory. Account receivable period equal 36.5 divided by receivable turnover, where receivable turnover equal credit sale divided by average account receivable. So this is the long formula for operation cycle. Basically 36.5 divided by cost of goods sold divided by average inventory plus 36.5 divided by credit sale divided by average account receivable. This is example of calculating the operation cycle. So we have this data. So firstly we need to know the inventory turnover. We need to know inventory period and how calculate this inventory period by inventory turnover, and we need to know account receivable period, and we need to calculate receivable turnover. So I will calculate basically one by one. So inventory turnover equal cost of goods sold, which is 8,005,000 divided by average inventory, which equal 2,009,000, so which equal 2.93. Inventory period equal 36.5 divided by inventory turnover, which calculate here 2.931. Receivable turnover equal credit sale, which mean net sale 13 million divided by average account receivable, which is here 2,025,000, which equals 6.419. Account receivable period basically equal 36.5 divided by receivable turnover, which calculate here 6.419. So now we have the operation cycle, which equal inventory period plus account receivable period equal 181.38, which basically equal 189 days. Importance of the operation cycle. The operation cycle offer an insight into a company operation efficiency. A shorter operation cycle is preferred and indicate a more efficient and successful business. A shorter cycle indicates that a company is able to recover its inventory investment quickly and possess enough cash to meet obligation. If company operation cycle is long, it can create cash flow problem. So, when we have operations cycle short, this is good for a company efficiency. And on the other hand, when we have the operation cycle is long, it might be a problem for the company. A company can reduce its operation cycle in two ways. Firstly, speed up the sale of its inventory by, for example, if a company is able to quickly sell its inventory, the operation cycle should decrease. The second method, reduce the time need to collecting receivable. If a company is able to quickly collect credit sale more quickly, the operation cycle would decrease. So better for the company to reduce its operation cycle by these two ways. Impact of operation cycle balance sheets. The length of operation cycle varies depending on how long inventory, receivable, and payable remain outstanding and may occur several times in one period. It is very rare that the accounting cycle and operation cycle coincide with each other. That is why each business transaction during the operation cycle is analyzed to determine which accounting cycle to record it in. When company fail to follow this procedure, the current accounting cycle record do not reflect the business transaction in each of the operation cycle. In that case, the financial statement, including the balance sheet, will not be accurate. Also, information a business transaction obtained within each operation cycle ensure proper accounting recording in their related accounting cycle. Business transaction within an operation cycle may become more complex when a company purchases inventory at a different time, allow various account receivable collection schedule, or occur other operation expense in addition to trade accounting payable. Without regular and effective communication between business and accounting people, accounting record from the current accounting cycle may not accurately reflect the ever-changing business transactions that take place in each of the operation cycle. Conclusion. It is important to understand the concept of the operation cycle formula, as it helps to assess how efficiently a company is operating. An analyst can use this cycle to have an understanding of company operation efficiency. An analyst would prefer a shorter cycle because it indicates that the business is efficient and successful. Besides, a shorter cycle also indicates that the company will able to recover its investment fast and has adequate cash to meet its business obligation. On the other hand, if a company has the longest cycle, then it means that the company take a longer time to convert its inventory purchase into cash. Such a company can improve its cycle either by implementing measures to quickly sell off its inventory or reduce the time need to collect receivable. For basically the operation cycle, the time from the purchasing good or material until the sell this good or material. So most company we have to operation cycle become shorter to this be good for a company and collecting the cash. So this is my reference, and I hope and thank you for listening, and I hope you enjoy my presentation.